Good evening, dear participants. A very warm welcome to you all on behalf of Corporate Laws and Corporate Governance Committee on this webinar on corporate governance for small and medium companies. I would like to welcome our chairman to the committee, CA Dr. Debashish Mitra sir, the past president to ICI, and a chairman to Expert Advisory Committee, and also to our vice chairperson, CA Shri Priya Kumar, vice chairperson to the committee and chairperson to the sustainability reporting standard boards. And today in the webinar, we are having with us the eminent speaker for the day, yes, CA Mohit Bhuteria sir. If we talk about the education qualification, sir is a FCA, insolvency resolution professional, registered valuer. And if we talk about the professional achievements, there is a long list to go on. The sir stood first in the Chartered Accountancy final in Eastern Region, and he has been a co-opted member at the Expert Advisory Committee of ICI for 6 years. He has also been a co-opted member in the study group of ICI on guidance notes and upgradation of existing AS on the basis of corresponding Ind AS and the guidance note on CARO 2016 and 2020. Even he has been a chairman to the Corporate Law Committee at ACAE and View Exchange. He has been impaneled as a quality reviewer, peer reviewer with FRRB ICI. And also he has made presentation on the Companies Act on number of corporates. And if you see, he has been addressed on taxation, has been addressing at many forums on taxations, company law, merger, demerger, and restructuring assurance and non-banking finance company issues at ICI, ICSI, MCA, and so on. So we are very great. We have in the great position as well as we are very blessed that sir is with us to share his expertise and knowledge on the today's topic. And yes, the topic is very important, as you all know that when we talk about the corporate governance, it refers about the framework of policies and the guidelines that inform a company's conduct, decision making, and the practice. And of course, this infrastructure is built upon, if you see, upon the 4 key principles. Yes, that is the accountability, transparency, fairness, and the responsibility. So with this, I would like just to hand over the session to our speaker of the day, to Mohit sir. Over to sir.
Thank you, Nisha ji, for the nice introduction. Thank you, Seema ji. Thank you, Corporate Law Committee of ICI, for inviting me to share my views on the immense importance topic of corporate governance for small and medium enterprises in India. As we all know, large companies, listed companies, and selected other class of companies are subject to corporate governance as per SEBI guidelines, which is mandatory in nature. But uh, unlike that, there is no separate specific corporate governance compliance for unlisted companies. But yet, under the law, there are various provisions which directly or indirectly states unlisted companies to comply with these certain provisions, which are nothing but akin to something like a corporate governance. Now, to talk of corporate governance before we start our presentation, what is this? What is this corporate governance? It is a system by which we can say that the companies are run, directed, and controlled. There are various mechanisms, processes used by various parties who are running the company, be it the other stakeholders in running the company. Now, this corporate governance is very essential for all companies, whether it is SME or whether it is non-SME, to ensure accountability, fairness, and transparency, as Nishaji was also saying in her opening statement. Now, but unlike large corporations, small and medium enterprises face a lot of challenges when it comes to implementing corporate governance practices. And why are these challenges? These are challenges are only because that they have limited access to capital, they have limited resources, they have limited expertise in terms of a domain expertise, manpower expertise, and often a very informal management structure. Something like we can say that there is a company which is a family-run company. All the decisions relating to the company are taken by the family members, who are in turn the board of directors, and amongst from whom are all and who are the shareholders of the company also. And generally, many family-owned companies which are small in size all decisions are centralized. Say there is a company which is run by father having two sons, so maybe other family members are the shareholders, the father and the son are the directors. The key decisions are generally, in principle, generally taken by the father or by the two sons when it comes to these companies, and the activities are centralized. There is, in many cases, there is no decentralization of activity. There are not much delegation of power, although it is said that they may have a senior accountant, they may have a CFO, they may have a company secretary, or may not also have a company secretary. But decisions making is centralized. It's generally upon the core family members, the key directors who take all the decisions, and therefore at times what it happens when decisions are centralized, confined to one or two people, then often it is found that decisions are either delayed, uh, best quality services are not obtained, even the professionals do not come wholeheartedly, to advise the company or to say about what is in the best interests of the company. Lack of incentives to them also demotivate them to give advice from the core of their heart. But now, if all these are overcome, then it can lead to a lot of benefits to SMEs in terms of access to capital, improved performance, better access to human resources, sustainability, management of risks. And if the work is decentralized and different departments are channelized different works, then perhaps the key members would be more focused on not only the growth and development of the business. So generally, what we find in that small and medium companies, they do not have a what you call a sustainable business plan. So they are working. So they are working, as I said, that since the work is centralized, decision making are centralized. So everything from bottom to top boils down only to a few key persons, and decisions are uh, left best to them. And therefore, since the substantial part of their time is utilized in all, even in administrative and other aspects, so they cannot focus much on you know business development, growth, opening up of, I could say, opening of branches, raising capital, raising equity, raising debt, which are essentially necessary for growth. And many companies, we say, even do not have a vision and mission statement. Like today, I am a 100 crore company or 20 crore, 50 crore company. What do I need to do? What I will be doing in the next 5 years in terms of my size, scale, area, geography of operations. So these are basically not done. So it impacts them only, but many a times they are also not aware that this is impacting them. So the biggest bottleneck to any establishing system of corporate governance is, first they do not first they lack resources, first they do not have that quality manpower, third they do not want to spend. This is the biggest challenge. They do not want to spend in growth and development of all aspects of corporate governance. So this is the biggest challenge. As I said, assuming there is a company, even if it is a small company with a turnover of say 100 crore only, earning a profit of 3, 4, 5 crores. Now, if that company is able to develop a vision and mission plan, a vision and mission statement as to what it will do in the next 4, 5 years, how it will achieve, then performing, then tagging the each of the milestones achieved against the actual performance, giving targets to different sets of people, then decentralization, like the say there is a company secretary, the secretarial department is best left to the decision of the company secretary. Then there is a CFO who manages the accounts and finance, there's a marketing head who takes care of marketing, and the board only comes with for decision making, and that too they employ and they entrust on the board directors with different skill strategies. You see, if we see listed companies which have grown quite large in size as compared to unlisted companies, which are again, so the one of the key reasons for their growth is number one, corporate governance, and the other factors like access to human resources, access to capital, all this comes once a company has a very clean slate, a very clean system of corporate governance, but with visibility. Only if you have a very good corporate governance, but do not have the visibility, do not have the resources, do not have the capability to execute, perhaps you will not grow. But then in today's time, in when the world has become so much competitive, so much technology oriented, so much AI oriented, SME needs people who can guide them as to in terms of their intellectual capital as to how to grow the business in the future, adopt constant technological changes, and and then grow. You have to grow taking everybody together. It's not that the promoters themselves will grow, the rest of the employees, the CFO, the rest of the board members who they have, kept, they do not grow. It is a collective growth, collective wisdom of all, which will lead to the eventual growth and success of the company. So this was, I think, some important, opening things. And here, uh, role of professionals, chartered accountants is very, very important. You see, what we have seen over the years, like I have been also practicing for last 3 decades, clients trust chartered accountants like anything. So when it comes to he having a basket of professionals, he having a number of professionals in his group. So whether it may be a lawyer, a cost accountant, a company secretary, or any other professional, what is generally found that he, relies to a great extent on chartered accountants and listens to his advice. So, as professionals, we should also advise them that look, if you want to grow from 100 crore to 1,000 crore company, you should have a vision and mission. You should have a business plan. You should have adequate resources at all levels, being in terms of access to capital, being in terms of manpower, being in terms of payment to the manpower, then only you can grow. So this is, very, very important. And I think as chart accountants, we are well, well versed, well have adequate domain knowledge, domain expertise even to advise them on these facets of corporate governance. So let us start our presentation. Uh, just a second. Yeah. So, so the so what we'll be discussing now is as to what is corporate governance, what are the legal framework. These are inbuilt in law. What are the legal framework for corporate governance? What are the key elements of effective corporate governance? What is the role of key stakeholders in corporate governance? The stakeholders being the board of directors, the shareholders, the bankers, and a case study on a failed corporate governance, which we will often discuss during the court of deliberation, that if at all there have been failure in the past, many companies have failed, many companies have been admitted to IBC, there can be multiple cases that it is a case of a business failure or it is a case of failure due to mismanagement, due to failed corporate governance. Business failures, of course, may happen even though the governance is good, but maybe due to intense competition, the business could not survive. And we have very cases where we see in a telecom industry a very, very dominant large player with huge deep pockets, huge deep pockets, led to failure of one time leader in a telecom sector. So that was certain something like a business failure and not a question of failure of a corporate governance. So that those a few cases which we will discuss now. Generally, if I ask you that what is your understanding of corporate governance? Is it establishment of robust governance structures? Is it a bureaucratic process? I would say we're bureaucratic process where decisions are made slowly. It is a mechanism, is it, or it is a mechanism to make decisions on behalf of shareholders or it is a mechanism that regulates relationship between shareholders, directors, or management, or none of the above. So let us try to make some our session interactive, and if one you can put in your short chat box as to what do you think, what is corporate governance? So anybody can put what is corporate governance, which you think A, B, C, D of the five, which is your understanding of a corporate governance? So I'm not getting any answer. Okay. So let me say. So I would rather say that, of course, yes, it is an establishment of robust governance structures. This is one thing which is must. It cannot be a bureaucratic process, because if it is a case of a bureaucratic process where decisions are made slowly, then it is a case of failed corporate governance. Is it a mechanism to make decisions on behalf of shareholders? No, it is not a mechanism to make decisions on behalf of shareholders, but it is a mechanism that regulates the relationship between shareholders, directors, and management. So please feel free to ask questions in between also. Now, as I said, corporate governance is a system by which companies are directors and controlled. And what happens in this case, should be a balance of interest between the different stakeholders. A shareholder is a stakeholder, an employee is a stakeholder, the management, the board is the stakeholder, customers are stakeholders, suppliers, financiers, and even the core community, that you have given a social responsibility to the society. So, as responsible corporate citizens, it is the duty of the company that you have to take care of everybody. You have to take care of employees in terms of their, working environment, their working hours, their working conditions, in terms of in terms of their remuneration, in terms of incentives to them. You have to take care of their customers. You have to be, quite good to your customers in terms of efficiency, in terms of delivery, in terms of deliverables. You have to very uh, good to your suppliers. You have to again take the interest of the financiers who provide you capital, and those financiers may be equity financiers, maybe debt financiers. So you have to take the interest of the company. You have to serve your debt well in time. You have to serve the interest well in time. You have to take care of the shareholders in terms of clean balance sheet, in terms of robust processes, in terms of reward to shareholders, because ultimately the shareholders are the owners of the company, and the directors are custodians. Directors, indirectly or directly or indirectly, I can think they are trustees who are running this company on behalf of the stakeholders. You have to also be a responsible corporate citizen towards the society. You have responsibility towards the society. You should not do anything which disturbs the society or causes any prejudice or harm to the society, in terms of your environment. Like there are certain chemical companies which dispose of waste, so they have to be quite they have to dispose of the meat in a manner which is provided by law. Plus, it should not disturb or cause harm to the environment, or cause harm to the society in general. Then we also know we have the provisions of CSR, that and certain class of companies having a certain level of profits of 5 crore and above, turnover of 1,000 crores, net worth of 500 crore and above. They are under mandate to spend 2% of their profits as CSR. But even if you are not that class of companies to which CSR applies, as responsible corporate citizens, one should also think of the growth of the society, because if everybody thinks of the growth of the societies, the ultimately the resources grow, the society grows, and the country grows, and therefore directly indirectly even it also assists in your growth. To give an example, there is a small company, there is a which is running in a village. Then in a village there are schools. It assists the schools. It assists the schools financially. It assists the schools financially. Many companies even devote a certain hours in teaching at the school. They send their employees to devote a few hours every week in teaching the students free of cost or at a concessional cost. So again, directly, indirectly, you are imparting education, you are helping students to read, write, to be literate, and this directly, indirectly, again, it is something like a chain which essentially helps not only in your growth of the company but also in the growth of the country. Again, getting governance right is essential to build public trust. This is very important because we see that many of us are, associated with the capital market. So we often see that there is a concept of price earning ratio, which we, P, which we generally call, and we see that there is a difference between company which is smaller in size and larger in size in terms of P. So therefore, if I say a company with a cement of 20 million capacity and a cement company with this a capacity of 100 million ton, they have a different P. The reason being the size and scale plus the capacity to absorb shock in case of adversity is better on a company with a 100 million ton capacity rather than a 10 million capacity. The difference in P. We also find a difference in PE in companies with good management. So a company which has a good management enjoys and good management, and generally we see MNCs, multinational companies, because market presumes that these multi companies are very high on their corporate governance standards in terms of integrity, objectivity, compliance with law, delivering return to shareholders in terms of managing their finances and clean balance sheet. So they enjoy a high uh, PE multiple as compared to company which generally the market perceives to be a company with not that great governance. And great governance, great corporate governance is not only confined to the financials, but it is confined to the all aspects as to who are the key stakeholders, who is one which is running the company. Many a times you will see the exit of a person results in you know uh, results in a fall in share price, and similarly an entry of a person who is said to have a expertise in a particular domain, and once he joins a company, this adds value to the company. Often in case of IPOs, we see that many companies in their pre-IPO placement want good marquee investors, so that this again adds a value of a public trust in these companies before the stakeholders, before the shareholders put money in the company. And we have seen a number of examples. To give one example, there is a company called Traxin Technology. So what we find that this company had a marquee of investors right from Mr. Ratan Tata, Mr. Nandan Nilekani, and a number of very good investors. So this again adds value. This adds public confidence that yes, if these very marquee investors, very high profile investors or these they must have analyzed this company, and therefore this company is one which is high in corporate governance. So this adds a great to a public trust. So again, many of the clients who try to come at IPO, we often suggest them that look, this governance now is very key to success. Market rewards handsomely a companies which are good in corporate governance. So therefore, it is always advisable, ideal that before that when you are going from a pre-IPO placement, try to get some great investors, good names, in your company. And when these good names come, they perform their own diligence. They carry out their own diligence of the company, not only in terms of business, but also in terms of governance. This is very important. Of course, putting money as shareholders, one would always like to see as to how the money would grow in terms of what is the business outlook in which the company they are putting in money. But at the same time, they would also like to see that who are the quality of people who are running the company. Are there is a perfect balance in the board in the different aspects or not? In different aspects or not? So many other things as investor they would see. But these are, and what is the level of governance? So as we know, we have also performed diligence, and many of us here have performed due diligence. So when it comes to due diligence, and when you see all the records, again the due diligence also reveals what is the level of governance in the company in terms of compliance with the provisions of law and all other aspects. So governance is very essential to big public trust in companies. So, as I said, uh, in terms of corporate governance, it is synonymous with the practices and processes used to direct and manage affairs of a corporate body. You have to balance the attainments of corporate objectives with alignment of your behavior, expectation of society, accountability to shareholders and all other stakeholders. So, the way the business and affairs of an institution is governed by board and management, how strategies and objectives are set, how risk appetite tolerance is determined, how day-to-day business is operated, how interests of depositors are protected, how obligations to shareholders are met, how long-term sustainable success of the company for generating value for shareholders and contribution to wider society is determined. All these are nothing but corporate governance. So it is not confined to one aspect, but it's confined to multiple aspects of now, when we come to corporate governance, let us also deal with law because corporate governance also requires compliance with law. And in a company, we have a memorandum, we have an article of association. A company has to confine its business to what is stated in the memorandum of association. The company has to function in accordance with the articles of association. Article of association is the rule, a regulation, is the charter of the company. And besides the act, even what acts will be performed by the board, what would be done by the shareholders. So what powers the charter gives to the directors that is determined, of course, subject to the provisions of the act. For what matters, even the shareholders need to come to the members to take their approval. Again, that is determined in the articles. Generally, you see, uh, many companies, small and medium companies, adopt the table which is there in the Companies Act. But we often advise the companies that you articles are a very important document, and especially in case of small and medium enterprises, especially in case of family-owned companies, where there are two brothers, three brothers, four brothers running the company. So they do not give any importance to the drafting of an articles of association. So often what happens, say there is a family with four brothers, there is a dispute between them. Often it is found that there is a divide, two on one side, two on the other, or three on side, one on the other. There is no effective representation of all in the, so maybe out of the four, only two are directors, maybe out of the four, only three are shareholders. And maybe it also many a times happens that the shares are not equally divided among the different family members. So there are different situations. Again, three powers take one side and they oust the fourth director. The fourth director becomes helpless because under the provisions of Companies Act, board generally has the power to remove a director, again subject to uh, compliance with law, subject to shareholders approval. So if three brothers side and they have 75% holding, they can very well remove the fourth director. Articles of association do not have inbuilt mechanism to protect the interest of the fourth director of the family. So what we say often that your articles should, be well drafted. One need not adopt a table. Articles should be adopted again in accordance with the requirement of that particular business, particular family, particular corporate governance framework, and a lot of attention should be put to that. So once this is done as a part of corporate governance, the company must abide by the articles of association. For example, I say the act says that company section 180. If I talk of section 180, that the company 180 applies only to a public company. It does not apply to a private company. Therefore, uh, a private company can very well borrow money beyond any amount with the approval of the board. Section 179 provides for that. Approval of shareholders for borrowing is not required by private companies under Section 180. Therefore, many companies in their articles choose to put that, okay, to the extent you are borrowing to the extent of capital and reserves, the board can decide. But if you are going to borrow beyond capital and reserves, you have to come to us as the shareholders. Similarly, when it comes to creation of charge, many companies in their articles, since maybe the board is not run by only family members. Maybe the board is left to the some professional management, and then they say that if you want to create any charge, you want to raise money, and by way of creating a charge, you come to the shareholder, we'll give you approval. So, so there are certain powers which the articles themselves, the shareholders themselves can keep with themselves, although it is not provided in that. Many companies, as good governance, say that if we see section uh, 100 and section 43 and 47 relating to vote at meetings, relating to quorum for meetings, relating to length of notice 101. Like many companies choose to opt for the optional exemptions given under the Companies Act. And in the articles, they say that yes, I can call a board meeting, I can call a shareholder meeting by giving 7 days notice. Although the law says that it requires a minimum 21 days notice, and again, you can call shorter notice, subject to compliance with Section 101 in terms of obtaining consent from the shareholders. But as private companies, one can even in their articles have that yes, so long as I am compliant with law, I can hold a general meeting by giving 7 days notice itself. So many things can be done. Now, coming to appointment of directors, we know as a good governance, the director gives a declaration that he is not otherwise disqualified. He gives his consent to act as a director. And what are the disqualifications of director? That is also given in section 164 section. So what happens whenever a company is proposed to be appointed as a director? Many a times, due to lack of knowledge, directors just blankly sign the DIR2 and DIR8. Even the receiving company who do not have the professionals, they do not look into whether they do not look into that whether the director is actually, they do not perform any background check. I should say a background check about the director. So many a times it may so happen that out of ignorance, out of lack of knowledge, or even out of ill intention, the incoming director gives his consent and states that no, he is not disqualified. But perhaps if a background check would have been done, a little assistance of a professional could have been done to find out the credentials of a director, taking his civil report and performing other activities. One could have come to know that no, this director is not a fit and proper person. He should not be appointed as a director. So, as good governance, what we say that please, before appointing a director, do his background check, see all the papers, and then only appoint any person as director. Else, appointment is easy, but removal of director often becomes difficult, and one should not pay a nuisance in his company by appointing such directors. Now, the Act also, provides the duties and liabilities of director. This is very important. The stakeholders should know that as a part of good governance, that they should act in accordance with the articles. Articles is the, ultimate charter, the rules and regulations of the company. You should act to promote objects, benefit all the stakeholders. The director should exercise duties with care, skill, and exercise independent judgment. He should not involve the situation where there is a conflict of interest or possible conflict. So I, as a director, am entering into certain relationships, certain contract with the company where there is a possible conflict of interest, and there should be an adequate disclosure of that conflict before any contract is entered. And we'll also discuss in the next few slides as to how to avoid this conflict of interest. He should not, director should not try to get undue advantage, and neither he should assign office because assignment of office is not valid. So director should be well versed that look, these are my duties. These are my duties laid down by the Act. These are duties under Section 166 of the Act. And when I join the company and hold the position of a director, I must take care. I have to speak. So if there are certain decisions which are taken, which is not interest of the company, which are not interest of the company, the director must raise his voice. We have seen in the last 10 years, in the last decade, we have seen that many directors have resigned, citing failed corporate governance. Recently, there was a newspaper report that one of the director of a leading wind power company resigned, stating that stay on account of corporate governance, on account of corporate governance. Auditors also, we have seen many auditors have resigned in the past. So director must, vote. Directors must come prepared when it comes to meetings. They must speak and they must speak their mind, and they also should vote in the interest of all the stakeholders. So the duties and liabilities director must understand. They are not just name lenders. They are not just representatives of the promoters or nominees of the promoters. Or so, but they have owe their responsibility not only under the law, but they are also equally responsible to all the stakeholders. Now, directors should also not know the consequence that in case there is a breach of duty, in case they are enter into any contract in which there is a conflict of interest, what could possibly have happened? So therefore, say there is a director who has entered into a contract of purchase of steel from a company. That company is a related party run by his son or run by his wife or run by his brother. He does not disclose the conflict of interest, and this contract maybe is not brought to the knowledge of the board. The transaction is carried out and at a price which is must at variance with the market price, which results in a breach of duty. So in such case, director has to account for the profit which has been made as a result of these, and it would be case of a failed corporate governance, I should say. Now, law requires except for the small companies where there is a window, a company shall hold at least 4 board meetings. The director should attend board meetings. They may board meetings either in person or through video conferences. Nowadays, we see that many companies, especially after the COVID, they have adopted technology, and it is not necessary for all directors to come at the place of the meeting. Directors choose to often attend meetings through video conferencing, through Zoom or through WebEx, whatever it may be. So it helps. Like we are today also discussing this corporate governance framework here. So many of us, I am in Calcutta. You all may be spread across India in different cities. So we are able to connect ourselves quite well. So similarly, in companies nowadays, most of the companies uh, avoid physical meetings to the extent possible. Although physical meeting is also essential, much essential, for interpersonal relationship. That is also very important. That yes, people come, people meet each other, they discuss a number of things are there. But then, yes, if you want to get the best brains, often you do not get the best brains at your cost, because say a gentleman has to come to you for a full day. So maybe he would come one day before. He would go on the day of the meeting, taking the night flight, last flight. So he says that I have to spend a lot of time. Rather in such cases, meetings are held, over Zoom. It helps a lot. It saves time. Nowadays, all the backup papers relating to meeting are sent by mail. Directors prior to the meeting also, generally, if they have any query on the agenda papers to understand the agenda and the backup papers, they would call the CFO, they will call the CS, they will call the managing director and discuss them about the different aspects of the agenda. So that is quite helpful. So directors, should must participate in the meeting in the board meetings to the extent possible. Now, coming to disclosure, as we all know, that in the first meeting, directors have to give a disclosure of their interest. This is a good governance that look, these are my relatives, these are the companies in which I am interested, and generally they give at the first meeting of the board, and whenever there is any change, they intimate to the company that look, I have been appointed in such and such company. Now, coming to related party transactions, this is one aspect which is abuse of related party transactions has been a matter which has been discussed not only in India but across the world, and this abuse has been a cause of great concern to everybody. So therefore, what happens through abuse? Uh, the promoters make money. They shift the profits from one company to another company. So it may be one company, maybe a listed company, where promoters have say 30, 20, 30, 40% holding. they would always obviously like to shift profits from this company to companies in which they have, say, 100% holdings or substantial holdings. So these things happen quite a lot. So they appoint related parties, pay them remuneration much beyond their the desired amounts which they are required to pay. They do not disclose their interest. They devise structures in a way where you could avoid related party definition as per 2 clause 76 or as per section as per AS 18. So these are very abusive practices. So even many a times it happens that there is a related party transaction, but the contract, but the that related party transaction is carried out without coming to the board or without coming to the stakeholder. Maybe the director, while giving his disclosure of interests, has not disclosed that related party. So these are quite bad governance practices. And and although those transactions become voidable, but in the interest of good governance, in the good interest of good governance, what should happen? Like in case of listed companies, there is an audit committee, there is a board, all related party transactions are scrutinized by the audit committee. But in case of small, medium companies, small, medium private companies, where Section 188 is there, they say that, okay, if your transaction is in ordinary course and arm's length, you need not come to the board. If the transaction is either not in ordinary course or not in on arm's length, you need to come to the board. And if the transaction exceeds a specified threshold, which is there again in the rules, then you go also need to go to the stakeholders. So many companies, what they do, they say that this transaction is on ordinary course, this transaction is at arm's length, therefore I need not go to the board. When a question is asked that, okay, you have decided that you have said that this transaction is at arm's length, how have you determined that this transaction is arm's length? Is there any document to establish that this transaction is an arm's length which led you not to come to the board? Plus, who is the one who has taken decision that it is at arm's length? So these questions, become quite difficult, and they try to avoid the board. They try to avoid the shareholders. So this is a bad governance. So promoters, directors should be quite clear, quite candid in terms of the disclosures in carrying out any abuse of related party transactions to serve their personal interest. Adequate disclosure should be made. Approval process should be followed. The phenomena of ordinary course, arm's length should be duly examined. Contract should be approved by the board, should be entered in the register, and even board, while approving such transaction, must apply all the diligence that is there. That look, this transaction which I am entering into with related party, not only in terms of price, in terms of the product, in terms of its quality, in terms of payment terms, all are at arm's length or are carried out at the same terms and conditions which this company is carried out to third party. Therefore, if Maruti sells a car to a third party for 5 lakhs on cash, same car, if it is sold to its director at 5 lakhs for cash, then one can say it is an ordinary course and arm's length because the business of Maruti is to sell cars. But if a car is sold to a third party for 5 lakhs and cash, but the same car is sold to a director at 5 lakhs for 3 months credit, it is not an arm's length. Because in an arm's length, not only the price, but the terms are very important. So one should be very careful as a for a robust corporate governance that your related party transaction should not be abusive transactions. So as we discussed, uh, key elements of countermeasure are integrity, the transparency. Board should be quite transparent, fairness, fair to all the stakeholders, be it customers, be it suppliers, be it employees. Honest, responsible, and independence. Directors must be independent. Entire board must be independent. They should not be biased or influenced by the decisions of their others. Yes, they can take advice from others, but then they should apply their mind, speak out their mind, and be independent in all the approaches. Plus, they should be accountable. So these are all the key concepts that are very essential to protect for a good, reputed for establishing a reputed company, for policy setting, for decision making, and for taking the best interest of the stakeholders. The importance of effective corporate governance. That if you are a company with a high level of corporate governance. Increased transparency. This would lead to increased transparency, increased shareholder trust. Company and its promoters all would enjoy commendable reputation. Like if we see, like India after the present our honorable Prime Minister Mr. Modi, the way he has handled the country, the way he has run the country, the image of the country across the globe has improved, and therefore we as Indians, when we go to any part of the country, this also, enhances our image when we go to them. Then there is maybe reduced regulatory sanctions. So if you are a good corporate governance company, you are compliant with law, then there may not be any penalties, any strictures on the company. There will be decreased conflicts and scandals, obviously, because as good governance, you will be have integrity, you would be independent, you would be fair, and organize efficiency. So what are the characteristics of a dysfunctional board, which generally happens in small and medium companies, where many times we see the board are dysfunctional in the sense that board members do not get along. Conflict is common. So there are promoters who may be friends, there are promoters who may be family members. So they are not interested in the company structure. They run the company as a proprietor, as proprietor. So they do not also get along with themselves. There is conflict. There may be conflict between two brothers when they are running. And in Calcutta, we have seen there are large cases of operation and mismanagement. There are large cases of operation mismanagement 241 because the board members do not get along, and when they do not get along, then there is a feud. There is a division amongst the members, and amongst the members, conflicts become common, and then they go and harm the company. To give you an example, there is a company with which we were associated. There were three directors, so three family members, each holding one third share. Now there was a discomfort of one brother of one branch of the family with the other two sided themselves, and the third was not apprised of the various aspects of the company, and he was kept in dark. His voice was not heard. So slowly, and there was a grudge which developed in the minds of the third member, and slowly he started accumulating evidence, and one fine day he went to the court. He filed a case for operation and mismanagement with all the papers. On the day of the first hearing itself, the board uh, frees the bank account. The company law board frees the bank account of the company, and they appointed a receiver. And then the smooth functioning of the companies was totally disturbed. So it is very important that each member is told about their responsibility. They should get along. So in many companies, what happens, they hold meetings. There are a number of companies which see they will regularly hold meetings, and they will enjoy the meetings, good lunch, good dinner, good high tea, but they do not take decisions. Many companies are there where the board afraid to take any decisions. So again, it is a case of a dysfunctional board. Now the board seems to move from crisis to crisis. So there is a problem. They do not try to solve the problem. They try to avoid the problem. Again, a poor management. Why? If there is a problem, one should try to overcome the problem, to face the problem. Challenges will be there. You have to face them. Many board members do not take their role seriously. So, in small and medium companies, as I said, promoters think themselves as the owners. They do not think that no, they are the appointed directors in the company, and as appointed directors, they have role, role to not only the shareholders again who are their family members, but they have a role to play in terms of various stakeholders, that they are responsible to the different stakeholders. They do not take their role seriously. So again, there are certain boards in SME where they work in calm times. They work. If their times are good, they are very good. Any cannot cope with change or crisis. In 2020, uh, after COVID, so COVID was one thing, which uh, affected many companies to a great extent. But what did show that many companies were not prepared to meet, to take the challenges. They were not technologically competent, uh, although they had resources. But what we found that in many cases, the employees could not work from home because they do not have any, say computers. Uh, they did not have all their data on a server. Everything was there in the hard disk, in the computer. The computer was there in the office. Now, members of the staff could not work from home, could not do anything because they did not have access to the record. They did not have they did not have any technological capacity. Many a times it happens that there is a competitor who is trying to disrupt the market. Now, instead of planning as to how to take on the challenge, they try to avoid. They do not try to apply their mind. And at times we say that, look, there are challenges. Everybody cannot face all challenges. Then you have to go to some expert as to how to cope with the challenges, how to come out with that. So, say there is a tax demand. The first thing the any uh, company would do, that he will send to his lawyer or his chartered accountant that, look, there is a tax demand, आप देख लो इसको please. Now, the chartered accountant, in generally in small Indian companies, he takes the onus. वो देखता है उसको कि भाई इसको हम कैसे, what is the case, कैसे solve करें ये. But when it comes to any business crisis, the board, try वहाँ वो professional का help ले लिया कि भाई, be it is a notice under a corporate law, be it something to do with income tax. Generally they take care. But when it comes to any problem in execution, any technological change, any competitive thing where they need not have any the desired expertise. They need not have the team members who have the desired expertise. So they have to hire resources. They have to go out to somebody else to take advice. But the board, shies away from doing that. Decisions are made, but they are not followed. They said, okay, now we'll follow this path. Like, we have a budget, we'll follow the budget. We have a roadmap, we'll follow the roadmap. But at time, promoter himself, overrules the decisions. So one fine day, they decide that these are the certain things would be followed: A, B, C, D, E. And later the promoter finds that no, 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 it becomes very difficult. So I overrule that. And so if you are yourself indisciplined as owners, then obviously all the employees automatically become indisciplined. So a dysfunctional board results in poor governance. It affects the growth of the company. It affects the growth of the stakeholders. So what is important, that the board members should go along. There should not be a conflict. Like in many companies, so if a particular decision is to be made, there may be a disagreement between them. So they put everything to vote, and whatever is the result of the vote, they follow. The board members are responsible. They know what to do. So if I am a finance man, I know what to do. If I am an operational man, I know what to do. A finance man would not advise an operational one man what to do and what not to. Neither an operational man will teach a finance man that, look, you plan your finances this way. If there are decisions required to be taken in a board meeting, then those decisions would be taken. If there is a crisis, a good governance would say, if there is a crisis, the board will discuss the crisis. The board will also discuss as to what steps to be taken to overcome the crisis, and they will take adequate steps to ensure that the crisis is over. In many companies, what we see, the first item of the agenda, they say, is the action taken report. That whatever we have decided that this should have been done, and these are the person responsible. So what they do at the end of the board meeting, they tell the company secretary that, look, अभी आज जो board में decision हुआ, एक तो बना लो, उसमें बना लो what is to be done, who is the person responsible, and by what time this would be done, and in the next board meeting, place that what is the status and outcome of those discussions. Again, this is very, very important. So uh, uh, a board should be very, very proactive, should get along. Only then the company can grow, and this is very essential for a good corporate governance. Now, let us come to So if there are any questions in the chat box, else we'll go along. Okay, okay, no questions. Now, what are the role of key stakeholders in corporate governance? So we have a number of stakeholders. So who are the stakeholders? The board of directors, around which are the public, the society, the auditors, the regulators, the shareholders, management, employees, customers, external consultants, suppliers. These are the stakeholders, and all have a role to play. The auditors also have a role to play, great role to play. The regulators have a role to play, and the company has its own responsibility towards the regulators in terms of compliance. Company has its responsibility towards the shareholders. So these are the different stakeholders. And what is the role of each stakeholders? What is the shareholders' role? Shareholders are the owners. They provide financial backend in run for a return over the lifetime. कि मैंने आपको पैसा दिया है, मैंने आपको फाइनेंस दिया है, अब आप मेरे को कमा के दो, आप मुझे डिविडेंड दो, आप मुझे बोनस दो, आप मुझे शेयर बायबैक करके रिटर्न्स बढ़ा के दो. सो दे सेलेक्ट कि कंपनी कौन चलाएगा, दैट हु विल बी द बोर्ड मेंबर्स, कौन कंपनी चलाएगा. Influential amendments to the regulation. जैसे मैंने कहा, articles of association, these are the regulations of the company. Then they first frame the regulations and also influence amendment. कल को हमको इस regulation में कुछ amendment है, तो it is the shareholder who has the right to do the changes in the regulations. Without shareholders' approval, articles of association of a company cannot change. They have right to influence decisions regarding change in capital. If a company has to increase capital, generally what we say, if you go for a right issue, unless the articles provide otherwise, the board can decide. But again, you have to offer to all the shareholders. The shareholders may choose to subscribe, may not choose to subscribe, may choose to renounce, may not choose to renounce. Now, if you want to go for a private placement, then obviously to allotment of shares to third party, then obviously you have to go to the shareholders that look, I want to raise money, I want to allow to persons other than you, please give me a dividend. Any extraordinary transactions which is required as per law or which is required in terms of articles. Appointment of auditors. Again, shareholder is a play. The first auditor is of course appointed by the board, but thereafter all auditors are appointed in general meetings. Casual vacancy also arising due to a resignation is appointed by shareholders in general meeting. If you have to declare a dividend, as far as interim dividend is concerned, board has the power to approve interim dividend, but when it comes to final dividend, again the shareholders. Plus, many companies in their articles again write whether or not you can declare interim dividend and what are the rights of the board insofar as dividend is concerned. Therefore, as a good governance, or if the shareholders want to protect the interest, they say that okay, whatever dividend is to be given, you are professionals, you are running the company. Whatever dividend has to be given, you have to come to us. That we say that even that for any dividend, it is the consent of the shareholders must be necessary, and of course the shareholders has to take decisions. So board has a supervisory role, board has a stewardship role in the sense that it holds managements to account, it guides and shapes the business, it helps set the strategy, it establishes the corporate culture, it defines target. So generally, how do board function? Uh, Say in the first board meeting, uh, the operations head, director operations, gives the business plan. And when this business plan is given, that what we are going to do in the next year, what we are going to do in the next 5 years, in the next 10 years, many companies set targets for a decade. What we will do current year, what we will do in the next 5 years. You see, in public domain, we have very large companies saying that, look, today we have 1,000 crore loan book. We expect to grow over by 30% year on year, every year. And by end of 10 years, we would have a loan book 4 times what is there. Then they would also say every year that what we had said to the extent what we have achieved, how we have achieved, and in case we have not achieved, why we have not achieved. So maybe due to COVID, many companies could not achieve. Maybe due to in present times, what is happening that a lot of money is moving to the stock markets. Banks are finding difficult to raise deposits, and therefore, if you are not able to raise deposits, you will not be able to lend. So their trade book, their loan book is not growing to the extent that they would have investors because of money, complete flight of money from the debt market to the equity market to different commodities. So, again, board discusses everything again if there is this type of crisis as to how to overcome the crisis. Now, even OECD had given a definition of corporate governance and says that effective corporate governance structures encourage companies to create values through entrepreneurialism, innovation, development, exploration, and provide accountability and control systems. So, a good board always would give, you know, uh, space for innovation. So, without innovation, you cannot grow. Nowadays, many people, there is a talk that AI will overtake uh, human beings. But again, there is a second thought that no, AI cannot overtake human beings. Now, that professionals with AI, people will AI will replace people without AI. It is something like that. That only those who have AI, who are have artificial intelligence, they would be able to replace professionals who do not use artificial intelligence. Because nowadays, if you see, 20 years ago, we did not have computers. If I talk of 90s, not only 30 years ago. 30 years ago, we did not use technology. We only had calculators. We did not have computers. So even we used to prepare trial balance. If I remember my early days in early 90s, I also used to prepare trial balance using my hand manually. Even we used to prepare balance sheets of clients manually, and then that was typed, and again a printout was a typed version was given. We used to make corrections. Again, a second typing was done. So matching a trial balance was also a great challenge with times. Now, trial balance is nothing. We hardly we during the course of audit we come across of an unmatched trial balance. So everything is there now. This audit trail has come, so companies hardly make any changes to the entries. GST, you have to upload the data every month. GSTL 1, 2, 3B, whatnot. So by the 31st March, nowadays most companies says that save and accept some year-end provisions, some year-end accrual of interest and expenses. By first week, we are ready. We are ready. Maybe a few bills are missing, which have not come. They come in the month of April. So by I should say even by 30th April, even small and medium companies are ready. So all why this has all happened. This has happened with the changes in regulatory environment, which MSMEs have been forced to adopt, has been forced to adopt, and changes in technological capabilities. So everybody has to be technological competent nowadays to meet competition as well as to grow. Without technology, if one would think that no, I would maintain books manually, that is out of question. Everything is on system, everything in system, that is not even talked about, that I will maintain my books manually. But everybody now, many companies are leveraging technology. We as auditors also are leveraging technology for, performing various audit functions. So we have discussed this, the fiduciary responsibility of the board, care, loyalty, compliance, most important. Uh, now, uh, in case of small and medium companies, uh, we do not have these committees, audited nomination, stakeholder, because listed companies and certain large public companies are mandated to have these committees. But many companies, what they do for the growth path, they seek professional directors, appoint professional directors, they form committees so that what they want that before it comes to the board at one level, it has been thoroughly reviewed, examined, and only filtered, and then it comes to us for any discussion. Thus, if you see NBFCs, in NBFCs, we have three categories of companies, three layers: base layer, middle layer, and upper layer. So middle layer companies, maybe these are many of the middle layer companies are small and medium companies. Middle layer companies mandatorily are required to appoint board subcommittees such as audit committee, nomination committee, relationship committee. And then these committees have different roles which are laid down in the act, plus the scope can be increased by the board in terms of their requirement. It can increase by the shareholders in terms of their requirements. So again, these committees, if you are a member of these committees, you have a what you call it, the functions, duties, and responsibilities which should be discharged, you know, meticulously. So this we have discussed. The board has to be very open, very honest. So discussion should take place. Constructive. It is very easy to criticize. It is very easy to criticize at the back, but constructive criticism is the most difficult. Criticism with adequate knowledge or discussion with adequate knowledge. Many a times it so happens that we have also seen that when we discuss a particular matter with a company that look, this is the provision of law, he would come out, no, I discussed with my friend without any thorough discussion. I discussed with my friend. I searched in the Google. So again, that is a half knowledge, incorrect knowledge. So many a times directors also do not come well prepared. They unnecessarily or unnecessarily argue, and many have a ego to a level that they always voice keep their voice high. So again, that affects the growth of the company. They are not disciplined. Many of them are not timed. They do not come. They do not read the agenda well. They are not well prepared. They do not. They try to, promoters many a times try to impose the decision on the other board members without any collective proper decision. So this again is a case of a failed corporate governance. And so, what is the board's role, as we said, in effective corporate governance? It should contribute and provide challenge to strategy and implementation. आप strategy बनाओ, आप decision लो, आप implement करो. Leave it to the persons who are implementing the decisions. Once the board has set out all the mechanics, they should not disturb the persons who are executing. And often कंसिस्टेंट डिसीजन मेकिंग जो है वो भी कभी कभी मोस्ट ऑफ द टाइम इट इज अच्छा है बट मेनी अ टाइम्स regularly what you call the changing decisions becomes very bad. Now articulate maintain a culture of risk awareness and ethical behavior. One should plan the risks. Again, this is very important. To give you an example, if you see in 2008 what had happened, that we all know what are the different risks for a business. It may be a credit risk, interest rate risks, it may be a asset liability mismatch risk, it may be a capital market risk if I am dealing in capital markets, it may be a foreign exchange risk if I am dealing in foreign exchange. So what had happened during that time? Many companies took loan into, I think it was sometimes in 2008, just before the Lehman Brothers crisis had happened. Uh, we are aware of a few companies. What had happened? They had taken huge foreign borrowings, and at that time, foreign borrowings used to come at LIBOR plus 2%. Say at that time, I think LIBOR was 2%, and LIBOR plus 2%. The effective cost was 5%, and in India, they used to pay 12 to 13% loan on bank. So there was a complete saving of 6 to 7% in terms of interest cost. Now, what was important at that point of time that they should have covered their foreign exchange risks, because now you are buying in dollar, taking loan in dollars, you have to repay the loan in dollars. So there would be a foreign exchange risk. So today you have taken a loan at say 50 rupees. Tomorrow, if the prices goes up to 55, then there is a straight 10% loss in terms of repayment. So if you have borrowed 1 crore at 50 rupees, 50 crores, you have to pay 1 crore at 50 rupees, then that is fine. But if you have to, the exchange rate increases from 50 to 55, besides the interest, you have to also pay 5 crore as a foreign currency risk. So many companies did not plan for that foreign exchange risk. They did not take risk cover. This resulted in a complete, wipe out of their profits, wipe out of their shareholder funds in terms of the foreign exchange risks. They used to import, they used to take foreign exchange loans without any risk. So all contracts were open-ended. Again, it was a case of failed corporate. Though in those times, many companies had huge capex plans, huge borrowings. It was something that everything is good. Business is there to stay. Growth is there to stay. So they, since from 2003 to 2007, what had happened? There was a complete, economy. Indian economy was booming. Everybody was putting capex, but many companies put capex beyond their capabilities, beyond a desired debt equity ratio. So what had happened in 1 year post the Lehman Brothers crisis, everybody had to hold their expansion plans. Now they had done borrowings, and if you imagine a company doing a say expansion of say 1,000 crores, and 500 crores halfway they are there, and then they stall the project. So on the that amount every year interest is to be paid. So again, failed corporate governance. It may be again a failed business risk because there is a business risk which was taken, but it is said that your debt equity ratio you should maintain an ideal debt equity ratio not beyond 2 is to 1. And if it goes beyond 2 is to 1, then perhaps you may be in crisis in case of bad times. So they did not manage that. There were many companies operating in capital markets. They leveraged their positions like anything, as if every day was a sunny day. And when this Lehman crisis come, the index had fallen in a period of around 4 to 5 months by 37%. But the overnight fall, companies which borrow and do derivatives trading, companies which borrow and do capital market trading, if they are not able to cut losses in time, the rise is slow. If you, whenever you see that today the index is at 25,000, so it took time to. But when index falls, 30% index fall, a 5,000, 4,000 point fall can be a matter of a few weeks. So sometimes it falls gradually, sometimes it falls very sharply. So what happens in case of very sharp fall? They were not prepared for this capital market risk. So this is again very important that you have to have a culture of risk awareness. And what are your potential business risks? Nowadays, if you see RBI, like in many companies, there have been inspection. RBI, the very fundamental question put by RBI to all NBFCs, that how are you planning risk? There may be an asset liability risk, there may be a foreign exchange risk. How are you planning to control the risk? Like even for, many companies who are doing fintech lending, if some clients who are doing fintech lending, that look, are you doing a DR drill, a disaster recovery drill, in the sense that tomorrow your system collapses, then how, by what time you are able to, restart your business? What are your backup plans? Have you done a disaster drill that if something happens to your business, you are parallelly able to start a business from a different location immediately, so that your customers and other stakeholders are not, disturbed. So again, this is very important. So, management of risks, many SMEs do not pay much heed because, see, the biggest challenge, as I said, for SME is hiring good resources. This is very, very important. Many a times we tell our clients who are prosperous clients that look, you have to have a corporate culture. Even as a SME, you may be a family-owned company, but in order to grow, you have to have a corporate culture, and for that you must take good people who have adequate knowledge of different domains, and therefore they will add to the company. Maybe they come to you 4 or 5 or 6 board meetings, but then you can always go them for the advice. Obviously, you have to pay them adequate compensation, but in terms of value they will carry, this may help you to grow the business. Say, there are many companies, who have grown because of these successful induction of the people who help. So you have a banker, ex-banker, who is on your board. He will help you in different ways in, raising finances as to how to minimize the cost of the finance, what are the alternate source of financing, from where you can raise finance, India, abroad. You have a company person who is a tax expert in your board. He will help you advise. Obviously, you will go to a tax consultant but again, you are an in-house tax expert who will help you. You have a person who is a strategist who advises various companies on different strategies. So such a person comes, he would have a different perspective. So hiring good people, hiring good resources again is very, very key for the growth and management of risk. So uh, this we have discussed. Uh, Being prepared for unexpected. Now, many individuals do not have a succession plan. So if You do not have a succession plan, then you leave the next generation to fight. And we have seen various many large corporate houses having also having the corporate battles, which used to take uh, the headlines of the media daily. We had the famous, corporate battle of a large, the biggest industrial house. Plus, this is not only confined to large industrial houses. This is confined to every second family. What we see, it is a big challenge for a person to lay down a written succession plan. So unless you have a succession plan in place, not only at your individual level as to how would you give your wealth to your different family members, you have also a different difficulty in a succession plan in the board. So there is a father, there are two or three brothers. The father is presently the chairman. The other three brothers are running, they are united till father is there. But what when once something happens to the father, the three of them would like to take the numero uno position, that no, now everything should be done as per my wills and fancies. Succession plan is not there, that who succeeds the father as the chairman, as the managing director, or any other position. And those things you should do come as a matter of culture. It's not that you write on a piece of paper or write in the a plan that this would happen, and that the day something happens to the father, the next day that is implemented. There should be a gradual transition, and there should be a gradual shift of power even during the lifetime. And what we said, that the board has a succession plan, which is to be, you know, that many companies have board where says that after 60 mandatorily a whole-time director will retire. He may be, appointed again on a contractual basis for 1 year, 2 year, again subject to the approval of the board of the stakeholders. Many companies follow this practice, so it's not that till life he is a whole-time director. In family-owned companies, obviously the board will not like to, give away these powers, but they do not have any succession plan. It's not that till 100 years a person would continue to go do the same thing with the same vigor, with the same energy, with the same spirit. So unless hands change, unless the young brains come and run the company, company would not grow. With this, large corporates have devised succession plans. Even in SME, one advocates that okay, today you are running, you have to slowly, gradually relieve yourself and come to a position that you act as a mentor, a philosopher, a guide to the young generation who is running the company, and smoothly during your lifetime give over the reins of the company. Be there as a philosopher, mentor, and guide to them, and let the company grow. Because everybody has a different set of ideas. And unless you adopt ideas of the new generation, the company will not be able to grow, because now what has happened is the change that times are really challenging. Birth of a camera in a mobile has led to the complete, almost like camera industry has gone with computers, typewriters have gone. So change is very important. Adoption of technology is very important. Now, uh, there are many companies uh, which do not have any whole-time director. Family-owned companies, non-family-owned companies, the non-executive directors run the company. So again, in such cases, it is their entities to hold management to account and ensure that they would have executives who are discharging their responsibilities properly. And there, these NSDs should have sufficient knowledge and experience, and they have to seek access to the expertise to run the company. So who runs the company other than the board? It is the senior management, who day to days manages. So the senior management should have expertise to manage the day-to-day operations, to take corrective actions in response to audit, review, assessment, and recommendations, to ensure compliance with laws. So in the terms of management, you have one which is the operations, that they have to take care of the operations. They should be well worked with the various types of efficient activities. One is the finance, the accounts and finance. So they have to take care of the balance sheet, financial statements, day-to-day payments, receipts, and so on, managing debtors, creditors. You have factory taking care of production, inventory, persons heading the factory. Then you have corporate team, level team who will take care of the various legal requirements. You may have an HR team taking care of the HR as well as compliance with various wages laws, wages and industrial relation laws. So there is a difference between a complete difference between the board and a management. The management does the day-to-day activities. The board is something who is one what we called as a standard setter, a strategist, mentor, a guide, a planner. But execution, day-to-day execution is to the management. Board is one with again shareholders. They take the risks, that what risks we can take and how we should plan the risk, how we should mitigate the risks. And when it comes to management, they would, follow the diktat, follow what the board says. So it's not that the management would take decisions on their own, but what is important is that the board take the decisions. Execution is to be done by the management in the terms of the framework which is set up by the board. Now we last come to reason for failed corporate governance. What can be the reason for failed corporate governance? Now, uh, why did WorldCom fail? Why did Enron fail? Why did Satyam fail? Or even in SMEs, if you see, there are many business failures. Every day we talk amongst ourselves also that look, we are small and medium chartered accountant firms. Uh, it has happened that large companies would entrust audit to large firms. So large firms, even today, more than 80 or 90%. I'm just trying to compare MSME with small firms. 80, so that we can understand things in a much better way. 80 to 90 firms, it's 70 to 80% are proprietorship. So can we expect a proprietorship firm to have all the expertise when it comes to audit? So if you are doing audit, you have to comply with 29 accounting standards. When you come, you have to comply with more than 40 auditing standards. If you are doing audit of listed companies or companies to which Ind AS is applicable, again, around 40 Ind AS standards. Then again, you should have knowledge of tax, you should have knowledge of GST, you have knowledge of corporate law. Now, often we ask if your client is any dealing in FEMA, if your clients have NBFC laws, plus there is a limit, one cannot do more than 8 NBFC audits, one cannot do more than 30 total audits, private companies, one cannot do more than specified number of tax audits. So often we ask that is it possible for a proprietorship to be well versed to take care of everything? And now in this challenging environment which was not there, say 2 decades ago, is it possible? Why would clients stay with you? Why would none the client go to a person? Because you then a proprietorship, obviously, for all obvious reasons, would have not that domain expertise, not have that domain knowledge, would not be able to afford resources and may not have resources. So now what is the need? So that is why what happens, the client as they grow, or even if they do not grow, uh, that if they want to mitigate the risks or if they are not able to get good advice, they shift from one firm to another firm, maybe a larger one with a better access to resources, with better knowledge, better capabilities. So this is the same set. And again, once when, so these are the one set of clients. Again, we have firms with 3, 4, 5 partners and maybe a constant of resources. So there is an audit in which you need at least 30, 40 people with huge technological capacities. So maybe the total size of the firm is itself is 15, 20, 25 people. So maybe they are not able to cope with large audit. And as you know, now there are deadlines, listed companies by 30th May, 31st May, 30th May, they have to do the balance sheet every quarterly limited review. So it is not also possible for a small firm to do multiple audits at a time. That is why the business goes on to larger ones. And one reason why again from these firms to much more larger firms for All would I say is corporate governance. Ability to take risks, domain knowledge, domain exercise, human resources, adequate supervision, a good working culture, competent people, all those are lacking. And similar is the situation with small and medium companies. So therefore, there is a small and medium company, say, for example, which is, to give you an example, there are many tech companies which are doing lending business. Now, uh, when you come to us for advice, so first, they do not have good board. They may have a person who is technically competent, very quite technically competent, uh, but and they may have also access to some finance. But then uh, many companies are not able to absorb the technology costs. They are not able to absorb the cost of hiring resources for compliance with law. So to give an example, many NBFCs now are subject to strict regulations, especially these fintech apps are subject to very, very strict regulations. So they need extreme technological capacities, which comes at very, very high cost. They need good, human resources to and techno and expertise to comply with all the regulations because now the NBFC RBI regulations are day by day becoming extremely tough. And RBI wants, all in full compliance with law in letter and spirit. So they face a lot of challenges. They are not able to hire good resources. They do not, uh, want to hire good names because it comes at a cost. And these eventually lead to a position where there is a business failure. So the question therefore is that with limited resources, will you be able to run this business? If you will not be able to run this business with limited resources, why not join hand with others? Again, now many companies, say smaller players, steel companies, smaller cement companies. So what has happened? They do not want to keep their costs high because it is the promoter who is an employee of himself. So he runs and manages the company. Then there is a very limited visibility for growth. So what that leads to, it often leads to he's either shutting down the business or selling. If you see the business of stockbroking in India, there was a time where there were a large number of stockbrokers. Now, what had happened with technological changes, with increase in size, over the years, what I've seen, the stock business, broking business has almost, been confined to a few selected players. Therefore, to name, many of us are also aware that today in India, the business is controlled hardly by 10, 15 top corporates who are stockbrokers. And what was the reason for shutting down of the shop of small brokers was not only a lack of capital but also a failed corporate governance, in the sense they did not visualize the risk that look, technology is coming, so we have to change according to the technological requirement. So there was a system where orders were taken on telephone. Now also orders are taken on telephone, but at the same time, a platform is built where one can do the transaction of buying and selling of shares without having contact with the broker. And this is one big passive business for which you have to have a very robust technology infrastructure. Small brokers lacked in that. They did not even hire best people with changing times to create strategies to be in business to adopt technology. So it was something like a person, again, a promoter driven company who himself uh, used to do everything and think was he was intelligent next to none. So never acceding to the advice of the others, never trying to take advice, never trying to visualize or anticipate and visualize that what can be my potential risks. How do I stand in the next 1 year, 3 year, 5 years? All those were missing. And this was the reasons that many small business have not been able to. So we had no Enron scam, WorldCom scam. So what had happened? It was a case of window dressing of books. That you are spending money in certain which has not resulted in creation of an asset, but you are capitalizing everything and showing in the book as a capital asset under capital WIP. So therefore, all your revenue expenses are going on the balance sheet side. So all these are funded through loans, borrowings. So the liability side is increasing, the asset side is increasing, the liability side increase is a true picture in the sense actually you have something for which cash has come in the company, which is to be paid. The asset, the amount which has been raised as liability has been expended, which ought to have been charged to profit and loss account, but has sit in the balance sheet in terms of an asset. And when there is, liability holders, the depositors, the borrowers, the creditors started demanding money, there was a time, or when it came to maturity, there was a time that this company could not pay its obligation. And there was a complete bust because it was then known that what is asset is sitting in the balance sheet is not an asset at all. It is a fictitious asset. This asset does not carry any tangible value. Nothing is realizable. So then what was the reason for the failure? And this company collapsed and shut down its shop, leading to a huge loss to all the stakeholders who were associated with it. So what was the reason? Complete failure of corporate governance. And therefore, who could be responsible? The board was responsible for a failed corporate governance because the board members should have raised their voices that look, whatever balance sheet dressing we are doing, it's not good. When they were raising resources for funding for revenue expenditure or for funding something which is not resulting in creation of an asset, again an alarm should have been done that look, we are raising beyond our capability. This would not result in creation of an asset which would generate cash flow to repay the debt. So again, a poor corporate governance. They did not anticipate what risks they are carrying in the business. Again, the audit committee did not perform well. They did not raise their voice. They did not brought out all the concerns. Even the auditors put a what you called a blind eye and certified the financials. So this was a case of a failed corporate governance, and this results in complete collapse of business. One more example we could discuss before we, go for a question and answer session was the famous tech case. So what had happened? So what had happened in that case? Um, uh, the money was siphoned to various private companies from the balance sheet. But what was siphoned from the balance sheet that was reflected in form of a fixed deposits, which never existed. So over the years, around more than 5,000 crores was siphoned by the company, by the company, by the promoters. But in the balance sheet, this 5,000 crores remained as an asset. Now, what this company wanted to do one day when it found that, look, the matter is going out of hand, it thought that no, I have a private a real estate company. Let me merge this real estate company with this so that somehow or the other, through the scheme of amalgamation, I would manage this 500 crores and ultimately my personal assets, which are in their form of a real estate in a company, would come in the balance sheet of the tech company to take care of the liabilities. But then see, it was a case of again a bad governance in the sense a tech company was trying to merge a real estate company, no synergy in business. There, what happened? Board raised a few board members raised their voice that what is the need to merge, and that was very essential. That what is the need to merge a real estate company with a tech company? We are in tech business. Why would we go and join hands to merge a real estate company with us? So there, they raised their voices. Shareholders and raise their voices that why we would like to invest our money in a company which is doing both real estate and tech and technology business. So a lot of voices were raised, and those who raised their voices Perhaps it would have been better if the existing directors who were there in the board for the last few years would have raised their voices, would have seen the financials meticulously, would have seen the other concerns which are emanating in the company to get a feeling that something wrong is happening. Many people sensed, and then this ultimately, we all know, led to the collapse of that company. So many people sensed during the course of deliberation, because at that point of time also people used to have investor meets, and many what you call very savvy, very what you call investors who are quite sharp enough, they try, they through reading the annual report, through meeting employees, customers, vendors of the company, large investors try to keep in loop with everybody to know that we have invested this amount in the company, so we should know everything about the company. A few investors sense that something wrong is happening in the company. Why? They thought that, look, 5,000 crore is sitting in the balance sheet, yet the company is not paying employees and creditors on time. Then something is wrong. And this they kept on observing, and during the course of discussion, it came to them on many occasions that, look, this company has huge FD, but still it is not paying its employees on time. Then this means it is not paying its creditors on time. This means there is something quite wrong with the company. Now, when a company with a 5,000 crore asset, obviously through various tools, even the finance could have known that something is wrong. So either they, participated in the fraud, or many of them were there who were not aware. This means they did not perform their duty to for which they were uh, liable to, as per part of good governance. That they should have, one should have raised questions, board should have raised questions, the CFO should have raised questions, many uh, management whistleblowers should have raised concern that, look, we are not paid on time, creditors are not paid of time, culture is very bad, but still you have used deposits. So one, what would have with open eye, with open mind, one could have questioned all these things, but that was not questioned. And this happened, did not happen overnight, that this has happened in one day. In his statement, he himself said that this has happened over a period of time, so over a few years. So everybody is on board. Again, it was a case of a complete, you know, a poor corporate governance. So therefore, what is the fallout of this? And we have seen in the IBC cases also, many companies, have dwindled. And what is the fallout of this poor corporate governance? Is it is a business failure, or it is a failure of corporate governance, or it a business failure due to change in government policies? We have seen last 4 5 years, from 2000, I would say 20, not 20, 2018, 19 onwards, that with IBC coming, at least very large companies with assets of more than 10,000 crores uh, were admitted to NCLT, management changed, and what happened? So who lost money in this? The promoters, obviously, for their poor corporate governance, they lost the money. The shareholders lost the money. In many cases, the entire share capital was written off. In many cases, or even if it was not written off, maybe you have 100 shares, you got only one share, two shares. Financial creditors, they bear the brunt. In one case, I know there is a case of a large company which the financial creditor got only 10% of their dues. Operational creditors in many companies hardly get any dues, or maybe 4, 5, 10% of their dues. Employees, yes, to the extent of 12 months, 24 months salary, they are protected, but what about their jobs? They lose. So what is important is that that in a whether it is MSME, whether it is non-MSME, every stakeholder, every director, every shareholder, to the extent possible, because shareholders cannot act at all places. They only come at AGM, and then in the balance sheet, through balance sheets, they can take questions. But when it comes to appointment of directors, framing of rules, regulations, altering the memorandum for which the object for which the company can carry out on a business, there they have to be, quite uh, active and alert. The CFO of the company, the finance head, who is the what you call the bloodline of the company. If the blood does not flow through entire body, then the patient will collapse. It is something like CFO. If finance is not accessible or is not to all the departments who want, all the people who want, then the company may fail. It was the duty of all those persons to see when that failure had occurred. And even when I was talking of the many companies which almost collapsed and management changed, two very large steel companies, oil companies, number of these. It was a case of a complete poor corporate governance, and that is why the Companies Act, 2013 Act, has, and even the SEBI regulations give a lot of importance to independent directors, a lot of importance to women directors who can act independently. But overall, you see, it is a case of a culture, and which has to emanate from within. It cannot be imparted. It cannot be implanted. That has to come within. Profit maximization cannot be a motto of any business. Rather, it would be a value maximization, I would say, value for everybody, all stakeholders, even society is a very important stakeholder. So for all stakeholders, value maximization is extremely important. And therefore, unless even an MSME, adopts good corporate governance, as we were discussed across different spheres, it would not be able to grow. Gone are the days where one could say that, no, I am a company, I am a promoter, my, decisions are final without discussion. Those days are absolutely, those days were not never there, but nowadays it is absolutely gone. No large investor would like to invest in a company with a poor governance. Even many directors, many companies, like we are chartered accountants, even we see that even when we tend to appoint, say, even articles, even new chartered accountants in our firm, even the articles try and find out that I'm going to join this. So what is the business of this? What is the professional capacity of this firm? Even if a CA comes to join, he tries and he does his homework. What I mean to say, he does the background check, he does his homework, and then only comes. So even people who you want to appoint as auditors, even auditors do a background check because as per law, we are required, and as such we do. So nowadays, people do not want to be associated with somebody who has a poor corporate governance. So whether it is an MSME or non-MSME, so it is very important for us as chartered accountants to, you know, imbibe upon our clients, to update our clients, to educate our clients on a good corporate governance. And this is, this is quite essential for growth across all spheres. Thank you. Thank you so much for a patient hearing. Thank you.
Thank you, sir. Sir, we have received queries also from our members. So I've just forwarded on your screen, sir.
Yeah. So queries
Yes.
from Nisha ji. What
Yes,
are
sir.
the? Yeah. One second.
Yes, sir. I'm
What are
just reading the query, sir, for
Yeah.
your reference. Yeah. The first query is, what are the regulatory norms applicable exclusive to SMEs? Is there a compliance checklist or website to access information?
So exclusive to SMEs, as I said, unlike SEBI, whereas they have a section on corporate governance, unlike NBFCs, middle layer NBFCs, again where there was a section on corporate governance section, where the regulator asks what minimum you have to do. For SMEs who are neither listed nor fall in that middle layer, there are no written regulatory prescriptions for what you call a corporate governance, but then all are, like we talked of role of directors. These are part of corporate governance, appointment of directors, resignation of directors. These are nothing but again part of corporate governance, although it is not under a chapter of a corporate governance in the Companies Act. But what a good governance would say that what is the duty of the directors? What are conflict of interest? What are related party transactions? What are abuse of related party transactions? So these are the norms which every company, what is the characteristic of a good board? These are the norms which every company needs to follow. There is no ready checklist, but maybe if you try and find out in net now, so artificial intelligence gives you everything uh, from which you can again develop it. But I don't think there is a ready checklist for this, to my knowledge.
The next query is, I am pursuing doctoral research on SMEs and about to start. So is there statistical data available free download on any government site for research studies?
I
Budget,
think
macroeconomics, and all these financial
yes,
data sources.
yes. I think data relating to MSMEs you will get on the central government site, or even in the Department of Statistics, or even in there is a site for MSME, micro and small medium enterprises. There you would get the statistics relating to MSMEs.
Sir, next query before us is with respect to ECG scores on SMEs available in public domain, or is it a paid information for us to relate it with published financial statements? Or
You
and
see,
also for that they are asking with respect to CSR data, whether available at entity level in NCA site for download and research purpose.
no, I don't think CSR data is available on MCA site, but yes, uh, uh, you would find there are very websites which give reports. Like we have a Zoba Corp, for example. We have a various website which fetch data from MCA and give reports. There, perhaps you can get it, but I don't think on MCA we do not have any collection of those data.
So the next query is with respect to SMEs, whether they are listed in NSC or what publications are available as reference material apart from secondary data in SMEs.
No, the data relating to corporate governance, you have listing obligations agreement. Their complete guidelines are given for corporate governance, that like corporate governance guidelines as per SEBI are applicable to a selected large listed companies. For smaller listed companies, it is optional. So entire thing relating to corporate governance, you can, for listed companies, you can get on SEBI listing obligations agreement.
Next query is there any government support to these small and medium companies to ensure corporate governance?
You see, these corporate governance is something which you have to establish and build in yourself. The act provides, various regulations. So what we said, you have to be have a high integrity. That is again a personal quality for a director. You have to have a good board. That is also a personal quality. Government does not assist you. Government tells you what you have to do in terms of regulatory prescription. As far as MSC is concerned, there is some help in terms of all payment to MSMEs. Like now, income tax also says if you do not pay within time to MSMEs, expenditure will not be allowed as deduction. Section 43B. Under MSME Act, there is a mandate that outward limit is 45 days within which you have to pay to the MSMEs, irrespective of your credit terms, failing which three times the bank rate you would liable to pay. Third, even if the company does not pay, and if you file an application to MSME Facilitation Council in terms of a case that, look, I had supplied materials to this company, it did not pay, and assuming you are able to make out a case, they pass degree, which is enforceable by a court of law. They also pass strictures for payment of interest. So that is why, and even government is doing a lot of things on, there are platform where they say that the MSME should upload the bill, assuming that company to whom you have supplied is also on that platform. And then the banks come and discount the bills. So that way a number of things are done. And many of the details you would put on the MSME site of the central government.
The next query is how to rationalize the cost of corporate governance specifically in small, especially
That
in
is a
small.
that is a question which we have no answer, because see, a cost, a quality comes at a cost. So our answer is generally when we say that smaller companies are not able to bear the cost. So what is important is that either join hands and become a larger company, or find out if you are able to, if you do the same work for the next 5 years the way you are doing without incurring much cost. After 5 years or 10 years, will you at all there in the business or not? So as I was telling about small proprietorship firms, like whether they will be in the able to, like, they are not in any meaningful, many of them are not in meaningful business as of now. So with so much changes happening, so many changes and so much onus on the auditors, it becomes very difficult that maybe now we know that, see, to your questions, a direct point, like listed companies, now it has become extremely difficult for proprietors to audit listed companies. Maybe they were auditing 10 years, 15 years down the line. Number one, they have to be peer reviewed. Number two, they have to be have that India's capacity to learn and adopt India's. Then they are subjected to NAFRA. They have to be well prepared with NAFRA. Now, I know there are many firms, many chartered accountants who do not want to do at all a listed company audit. So then they are shying away from big audits. So to your answer, if you are not able to absorb costs, better join with others and make yourself of a size where you will be able to absorb cost. That maybe next 5 years, 10 years the line, the company will be out of business. Again, my personal, it is my personal opinion.
Yes, sir. The next query is that the member is asking that I find in many SMEs there is no provision for the chairman for the board of directors, and that starts the trouble in the meeting. So, is it advisable to have a neutral chairman mandatorily?
Right. So you see, who will appoint chairman? The shareholders will decide, the promoters, the directors will decide. Now, in articles, we try to define as to who should be chairman. Either your articles will determine, or you say in the articles that at the meeting of the board, the directors will decide as to who should be a chairman. Now, if there are three, four brothers, as I said, all of nearly same age or near about age, then often a fight arises as to who will be chairman, because there is a ego fight. There is a fight that the chairman is a casting vote, and everybody fears that something the chairman may or may not be able, may be able to gain to my advantage. Now, it is a culture. Then there has to be, some principles, some imbibed in the articles of association, which would define who will be the chairman. I would not say a third party chairman is always good, because you do not know whether that third party chairman will be able to run the company, especially in case of promoters family. So unless there is consensus among the promoters, and because they are the only one who are to decide as to who will be the chairman, then that would become difficult.
The next question is how to enhance the power of statutory auditor to protect the interest of all stakeholders by ensuring the independence of auditor under the corporate laws.
These principles are already there in the Companies Act. A lot of powers are given to the auditors. It again depends whether the auditors are want to use these powers or not. It is something like that. You are appointed for 5 years. So during this period of 5 years, your position cannot be disturbed. Law has provided very strict guidelines for removal of auditors. Removal of auditors is also not a very simple thing. It requires approval of central government. Generally, auditors do not want to exercise their power. Inbuilt power of there. You are liable to report fraud. You are report to anything which comes to your knowledge, which is of a serious nature, to the audit committee, and if audit committee is not there, to the board. आपके पास पावर बहुत है, आपके पास कलम का ताकत है. Even the Prime Minister once said, the power, my signature has more powerful, is less powerful than your signature. आपकी एक signature से बैलेंस शीट इधर उधर हो भी सकती है. So all it depends as to, and but then we think that अगर हम ज्यादा पावर एक्सरसाइज करेंगे तो हो सकता है क्लाइंट चला जाएगा. बट दोज डेज आर गॉन. आप अब वैसा मत सोचिए. आपके पास बहुत पावर है. अब इट इज समथिंग लाइक आप हनुमान जी हैं, उनको अपनी शक्ति को बारे में बताना था, तो मैं आपको बता रहा हूँ आपके पास बहुत शक्ति है. अब वो डिपेंड करता है वेदर यू वांट टू यूज दिस पावर और नॉट.
The last question, the last question is that a company is required to induct independent directors and have various committees. If it fails to comply with related regulations, including having audit committee with fewer members, then what is the role of the statutory auditor in terms of reporting?
Yeah. So Can you just repeat a question? काफी लंबा
Yes,
था.
sir. Yes, sir.
I'll answer part by
I,
part.
even, sir, even I've asked just half of the question.
अच्छा.
Yes, the question is, a company is required to induct independent directors and have various committees. And if it fails to comply with related regulations, including having audit committee with fewer members, then what is the role of the statutory
Right.
auditor in terms of
Right.
reporting?
Right. ठीक. So very important question. So let us say कंपनी को 3 इंडिपेंडेंट डायरेक्टर अपॉइंट करना था, उसने एक ही अपॉइंट किया. So we see SA 50 consideration of laws and regulations. If there is a non-compliance of the act, then it is our obligation to bring it to the attention of the board or audit committee board. And for remedial measures, अगर वो नहीं करते हैं, then you have to see whether it is a matter which impacts the financial statements and you have to qualify. This is one point. This relates to both directors and this relates to both audit committees. Now, अगर company में audit committee नहीं है, again it was required to constitute audit committee as per 177. It has not constituted an audit committee. Again, SA 250, आप वहां पे जाइए, देखिए, वहां बोला है कि इफ इट इज यू ब्रिंग इट अटेंशन टू द बोर्ड, अगर उसको रेक्टिफाई नहीं करता है, देन यू हैव टू डिसाइड whether it is a matter of qualification, emphasis or other matter.
For the further part of the question,
हाँ.
financial penalty for non-compliances has upper limits. So if such provision made and disclosure of non-compliance made in financials, whether auditor can remain silent in audit report since true and fair view not affected?
Yeah, there is a question कि there has been a non-compliance of a particular provision of law. So a company may be subject to penalty, may be subject to penalty. It is not that penalty is automatic. And if up, and also there is a provision कि the quantum of penalty which is laid down in the law, if you see the orders of the ROC or the RD or the courts, say there is a penalty which is laid down in law of 5 lakhs, many a times it is reduced to 50 lakhs. So therefore, if there is a statement in the financial statement that there is a non-compliance of a particular law which is liable to a penalty, unless that penalty is imposed, it does not crystallize into a liability payable. One can draw emphasis of matter if there are material points, if there are material non-compliances, one can draw emphasis of matter. But if they are so material to the financial statements, you can qualify your report.
Thank you, sir. It was a wonderful sharing of your experience and expertise with our members. And really, sir, it was a wonderful session because you have touched upon various important aspects related to the corporate governance, the various important legal frameworks related to appointments, duties, and responsibilities, as well as, sir, with respect to the key concepts and the in case of poor corporate governance also. So that way, it was a wonderful. And thank you, sir. Now over to Seema to for the vote of thanks, sir.
Thank you so much, sir. I hope all our participants are feeling as enlightened as I am after this insightful webinar on corporate governance for small and medium companies. On behalf of Chairman Corporate Laws and Corporate Governance Committee and Vice Chairperson and the entire CLCC team, I extend my heartfelt thanks to all of those who have attended this program, and a special thanks to our esteemed speaker, CA Mohit Bhutedia sir, for sharing your profound knowledge and expertise with us, and also providing valuable perspective that will undoubtedly help in advancement of the corporate governance within the organizations to our participants. I would also like to express our gratitude to all the participants who have joined us from different parts of the country. Your active participation through engaging questions and discussion have enriched the dialogue and added immense value to the webinar. Thanks you once again. Thank you so much, sir.
Thank you.
Thank you.
Thank you.
Yes.